Welcome back, everyone. Today's episode is going to be one of the more talkier episodes that I do rather than the big, flashy, loads of graphics and stuff everywhere. This is because there's been a lot of important news this week, like Boris Johnson raising dividend taxes, and the FT here has said that dividend tax rises are a kick in the teeth for investors. I disagree with this, and that might surprise you as somebody who kind of loves dividends. Then I want to focus on the importance of valuation, and I want to discuss this through the medium of Peloton. Peloton just yesterday released its new clothing range, which sent the stock up about 10%. So I want to discuss Peloton's price and whether it deserves the price that it's got. And lastly, I've had a lot of requests about my cows recently, so I'll do a very, very quick update on how they're going right now.
The sucker's going up.
So let's start. Boris Johnson has raised dividend taxes and national insurance taxes by 1.25%. That's actually quite a lot, and it will affect a lot of people out there. But it does affect people with higher incomes a lot more. From a pure national insurance point of view, it doesn't seem to have targeted the middle classes too strongly. However, it's not an accident that the rises have been targeted on national insurance and eventually income tax and the rate of dividend tax. If you're a limited liability company, it's well known that you can do a little tax dodge by paying yourself a dividend rather than paying yourself in normal income tax. So raising both the national insurance and the dividend tax keeps both of the taxes at the same level as they were before, but generally everyone is worse off. So this seems to have kept the limited liability business owners still at that advantage that they always used to have. From the perspective of dividends inside an investment portfolio, my portfolio is all in an ISA. Having all of my dividend paying stocks in a stocks and shares ISA means I don't pay any tax on this at all. This might affect people that have way more assets than they can put into an ISA, or they could rely on their income outside of an ISA, but this really should affect only a small amount of people. What I'm aiming to do is keep all of my dividend paying stocks in an ISA, and hopefully I won't be paying any tax anytime soon. And I suppose quickly here I'll mention that my portfolio value is now 36,406 and I am now 13% up in unrealized gains. This is down quite heavily this week and it's allowed the S&P 500 to gain a little bit on me as well. This has probably been my worst investing week since I started. I'm down probably over £1,000 just in this week. But that's what investing is. You've got to take the rough with the smooth, and some weeks are just not going to be good for you. Hopefully over a long period of time, these little weeks where I've lost £1,000 in 1 week won't even matter. I won't even remember them. Because hopefully I've picked some businesses that are likely to transcend recessions and are likely to be very strong over the next 10, 20, maybe even 30 years. One concern I did have about dividend payments being taxed would be that companies would be less likely to pay dividends out. I was very concerned that companies are more likely to use share buybacks to pay back to their shareholders rather than dividends. But according to data from AJ Bell, the FTSE 100 is still increasing its dividend payments year on year. We've had this 2-year lull during 2019-2020, but eventually these companies are returning back to paying their full dividend. But dividends are not the be-all and end-all from me. It's not just about gaining that cash flow to increase compounding over years. Dividends for me are a great indicator of high cash flow producing businesses. When I find companies that have increasingly paid their dividends over a long period of time, I can be quite confident that these companies are going to continue doing this. And historically, companies that do this outperform the market. My aim is to find excellent companies that produce high cash flow at really good prices. And I do this by trying to evaluate them based on their cash flow growth. Now, one company that I've been trying to value recently is Peloton. Peloton had an excellent year in 2020, benefiting heavily from stay at home and selling their treadmills and bikes to people who were stuck not being able to go to the gym. And its latest earnings report was pretty abysmal. Most importantly was that total revenue grew only 54%. 54%? 54% is very, very good. Do not get me wrong. It's absolutely excellent growth, and it shows that Peloton is going to be an excellent business going forward. In quarter 4, it was supposed to be profitable. It was supposed to be earning about 28 cents a share. But in reality, it's come in at a loss of $1 per share. Average monthly workout levels is dropping to mid-2020 levels when people didn't really have a Peloton. It wasn't really until Q3, Q4 that people started to buy more Pelotons and therefore started to use them. So the fact that now more people have Pelotons but are using them less, even less than 2020, isn't really a good sign. Quarterly workouts also dropped, which has never happened in the company's history. And this week, Peloton has gone up 10% because it's now released its own clothing line. And it does look pretty good. The clothing line looks pretty good. It looks a lot like Gymshark, and you can really see exactly where they're going with this. Does it have the brand recognition of Nike or Under Armour? I'm not entirely sure yet. But we can have a look at Gymshark, which is probably one of the best comparables to Peloton's clothing range. And at the moment, Gymshark is valued at around 1 to 2 billion. So straight off the mark, I'd be happy to say that Peloton's clothing range is worth at least 3 to 5 billion on top of what their current valuation is right now. I also think that the treadmill problem that they had is a total red herring. There is no reason to think that Peloton will not recover from this. What happened with the treadmills is very bad, but Peloton is most likely to survive that. But I haven't got a problem with any of these things. I don't think that it dropped the price of the bike because it wanted to. I think it dropped the price of the bike because it had to. There is no arguing that Peloton's brand isn't excellent. It's got a great following and it's got a great product as well. No one other than me says that Peloton's bikes are eventually just going to become clothing racks. I do think though that Peloton's price drop wasn't their decision. It wasn't in their plan all along to drop the price. They were forced to do this because their earnings are not living up to expectations. Which brings me on to the very, very important point that I have about Peloton. Before Peloton's terrible earnings report, it had an earnings per share of 0.28. Then next year, it was going to grow further, 0.97. The year after this, it was 1.89. The year after that, 3.5. And finally, in 2027, we're expecting Peloton's earnings per share to be around $6.80. According to analysts, this has all changed now since they had that terrible earnings report. And according to analysts right now, there is no way that the drop in the price of the bike is going to force people over to a software as a service model. I personally don't think this at all, but I do think this is Peloton's only move to move people over to the subscription service. The fact that they need to do this actually indicates to me that Peloton may not have such a good moat, and it also lacks a bit of pricing power. But our job as investors may be in this case to let all of this go. But let's let it go that their design team allowed some of their products to be unsafe. Let's let it go that their brand is so good that they're going to be in every single insurance company, they're going to be in every gym, and they're going to be in everybody's home. People are only ever going to buy Pelotons. Let's let it go that their clothing line may or may not be that good. And how about we even let it go that their subscription service has the lowest churn rate of any software company ever, even though that churn rate is increasing every year. Let's ignore all of that and let's see where Peloton might be in 6 years. Now, up until last quarter, Peloton had a PE ratio of 120. If it stays at a PE ratio of 120, in 6 years, you can see a 41% annual rate of return for the next 6 years. That is incredible. And this is based on a 343% growth in 2023, a 246% growth on top of that in 2024, and then 80 and 95% growth going forward to 2027. And I'm sorry, but these are unbelievably big numbers, especially as this year they started to lose money again. But I will say that a healthy PE ratio of about 30 may be more realistic for this high growth company, because it is a high growth company. It's an amazing high growth company with a great brand that's projected to grow at around 90% a year. And if we follow this valuation, we put it at a PE ratio of 30 in 6 years, because I don't think PE ratios of 120 to 300 are really realistic in 7 years. I really don't think that in 5 years, PE ratios are going to be as uncool as they are right now. So if you do think that over the next 2 to 3 years, Peloton is going to grow at 300% on average, and then going forward after that in 25, 26, and 27, that Peloton will grow around 85 to 95% each year, then in 2027, you are likely to have earned 11% per year on your investment, which is not bad. I would be more than happy with that return. But this is in no way a safe return. And do we really think that Peloton is going to grow 300% in 2 years and then continue that 100% growth every single year? Personally, I don't see it. This level of growth would mean that everybody in the UK needs to have a Peloton in their house. Every person in America has a Peloton in their house. And then some people in Africa will be paying the same price of prescription for the same product. Oh, I can't even say it. But what I'm saying is that Peloton needs to get into emerging markets at the same price to achieve this level of earnings growth. And it's worth reiterating that this is earnings growth and not revenue growth. This is the level of profit that they have to make. And personally, I would rather be a little bit more conservative. I've tried to increase Peloton's earnings growth rate by 50 to 60% per year. From the 54% growth in revenue this quarter, I've tried to exponentially grow the earnings of Peloton going to 2027. And that's 66% in 23, 150% in 24, 60% in 25, 87% in 26, and 67% in 27. And I tell you what, just for the laugh of it, I'll keep the multiple at 120. And based on this calculation, you're likely to lose 20% per year on Peloton for the next 5 years. And I don't think this is too conservative. I can grow Peloton's earnings at 150% a year, and it still loses the shareholder money. And this doesn't even take into account the fact that they're diluting their shareholders by an incredible amount. And this is all because Peloton's price right now is too high. Everyone got a bit too excited in 2020 thinking it was going to be the next big thing. But right now, I can safely say this is the only company that I've ever been bearish on. Shudders for me to say that. But it just seems that Peloton's valuation is so high in comparison to what it should be growing that I don't even have a story in my head where I think this company can achieve this level of growth. If it's a company like Tesla or Square, I can see it. I can understand that Tesla could be an energy company and it could continuously grow. The mega packs are growing and the valuation could eventually be worth it. But with Peloton, even though it's going to be well connected, it's going to have an excellent brand, clothing range now, I just cannot figure out how this growth is going to match this share price. I know that not a lot of people are going to agree with me on this. They're going to have the great narrative and the great story in their head. But I promise you, I have tried to understand this narrative. And if I'm really missing something, let me know. Okay, I had an email the other day from James that says, Paul, love watching your videos. Any chance of an update, even just a mini update on your investment into Livestock Wealth? Keen to hear your experiences before investing on the platform. And James isn't the first person to ask me. I've had people on the Discord and people on the comments asking me about my cows. As far as I know, they're still there, but obviously I don't live in South Africa. I'm nowhere near Hentic Mirage Farm, so I haven't got a clue if those cows are still there or not. But I don't know how much I'm going to earn from these cows. It's not like a trading 2-on-2 investment. It's more like a house investment where you just don't really get regular updates on the worth of your property. And I'm not going to find any more information about it until November of 2021. That's when I'm planning to start getting things together and start building my video on my experience with Livestock Wealth. What I can say though is that they are very good at keeping in touch. I get automated updates from them all the time. I even get emails every month or so to remind me to update my nominee account because I haven't done that yet. Livestock Wealth seems to be growing their technology as well. They've just brought in these new app features which aren't available to investors yet, but they're definitely available to the farmers, and they have said that these technologies are going to be coming to the investors soon. And these are simple tracking tools where a collar is around the animal's neck and it basically tells you where it is on the earth. It gives the farmer a geofenced ring and tells them when their cows have stepped out of their farm or if their cows have been lying down too long, all sorts of different stuff. I doubt the investor is going to get all of this information, but it will be nice when eventually I can track my cow and see it walking around its little field all day. There isn't that much to update you on, and expect the next update to be sometime probably in December of this year. Thank you very much for watching, guys, and if you enjoyed this video, please feel free to give it a like, subscribe, and invest if you want to.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.